Hello, my name is Jonathan Wilson, and I'm one of the co-founders of the FinCEN Report Company, and welcome to the FinCEN Report podcast. Today, we're going to be talking with Harry Dixon. Harry is an executive and a lawyer with MUFG Bank in New York City, and his expertise is in financial crimes compliance, a topic that, of course, is very near and dear to our mission here at the FinCEN Report Company. Now, one of the topics we're going to be covering is FinCEN's new access rule. If you're one of our regular listeners, you know that FinCEN has already issued a final rule on the reporting requirements of companies under the Corporate Transparency Act. That law takes effect at the end of this year, and beginning on January 1, 2024, reporting companies are going to have to file with FinCEN a beneficial ownership report that identifies the beneficial owners of the company and then provides 5 very specific pieces of PII with respect to each of those beneficial owners. Now, the second half of the FinCEN rulemaking deals with what they're going to do with all that data, right? So FinCEN is going to collect all this data. It's going to live in a giant registry in the FinCEN cloud, and they're supposed to, by statute, make it available to U.S. law enforcement, in some situations foreign law enforcement, and then also to banks in the United States. So the regulatory question is, what should be the rules to govern the ability of banks and law enforcement to get access to the FinCEN registry of beneficial ownership information? So FinCEN did a first draft of its regulations. It's called the Access NPRM, and we've talked about that on our blog. And that Access NPRM has received a fair amount of criticism. On the one hand, the American Bankers Association and 51 state bankers organizations submitted a commentary letter that basically told FinCEN to start over again. They were so frustrated with the requirements. They viewed the FinCEN approach as being too heavy-handed and imposing too much of a burden on the banks for their ability to get access to the registry of beneficial ownership information. At the same time, a bipartisan group of senators, including liberals like Elizabeth Warren and Sheldon Whitehouse and Ron Wyden, and some conservatives like Chuck Grassley and Marco Rubio, co-wrote a letter to FinCEN, saying that they were very concerned with the approach that FinCEN had taken. They didn't quite tell FinCEN to start over again, but they did say that FinCEN's approach had strayed from congressional intent. And when you're the senator that sits on the Senate Finance Committee and has a very loud voice in the making of budgets, especially the budget for FinCEN, I'm sure those opinions are important opinions in the minds of the regulators at FinCEN who are working on this regulation. So we don't know yet exactly how the FinCEN access rule is going to turn out. We do know it will have a big effect on how banks can access the registry of BOI as soon as the law is implemented. And the opinions of legal professionals like Harry, who would eventually be involved in implementing these regulations, I think is an important touch point for us as we watch this process unfold. So in just a moment, I'm going to introduce Harry Dixon with MUFG Bank, and we're going to talk about the access rule. Thanks for joining us. So Harry, thank you so much for joining us today.
Thank you, Jonathan. It's good to be here.
Great. Good to see you again. And so we were talking just before we got started. You have a role with MUFG Bank, and why don't you tell everybody a little bit about what that is?
Sure. So for those of you listening, you may not know this, but Jonathan and I actually practiced law together in Atlanta for a couple of years. And in 2019, I had the opportunity to go to MUFG Bank Limited, which is a Japanese bank, and their New York office. And for the past 4 years, I have been doing financial crimes compliance. The first 3 years in that role, I was helping our subject matter experts develop policies and procedures for financial crimes compliance for the bank and anti-money laundering, economic sanctions, anti-bribery and corruption, and all of the operations that are related to that. About a year ago, I made an internal transfer within my department, and now I am helping manage our portfolio of regulatory exams and internal audits across the globe.
And Harry, you're a Japanese bank, but you have a U.S. branch. So from a regulatory point of view, what U.S. laws apply to your branch that are either the same as or different from the laws that would apply to other U.S. banks?
In general, the laws are the same. I think that the one extra wrinkle that we have is because we're an international bank, we are subject to Regulation K, which means that we have to have a holding company that serves as an intermediary between the parent company in Tokyo and then our subsidiaries here in the United States. But in general, yeah.
Basic Bank Secrecy Act stuff is going to be the same.
Yes. And of course, keep in mind that because we are an international bank and we have offices in London and Tokyo, Singapore, we actually have an office in Moscow. We are also subject to other laws in other jurisdictions. I think in my personal experience that we tend to take the lead of what the United States is doing, but we do have to cross-check other laws in other jurisdictions. Okay,
and so I think a lot of our listeners are familiar with the KYC or the CDD rules. So if a corporation, a company is opening a new account with a bank, including your bank, they have to give you some information that identifies the beneficial owners of the company. So why don't you describe people how that works today?
Right. So when you open an account, you are going to be providing you're going to be providing certain types of information. Typically, you'll be providing at least one form of government ID. You're going to be needing to provide, current address. You're also going to, from the bank's perspective, once you submit the required information, it's going to be analyzed. And one thing that a lot of your listeners might not know is that this is also going to be compared against the bank's internal risk portfolio. So, for example, let's say that you are a national from the Russian Federation. That for any bank is going to be a higher risk rating right now, given what's going on in Russia and Ukraine. And that doesn't necessarily mean that your account will get blocked from a CDD perspective, but it does mean that you will be considered a higher risk potential customer.
Sure. So you're collecting the sort of information about a corporate customer that would get information about the beneficial owners. And for purposes of your KYC procedure or your customer due diligence rule, who are the beneficial owners of a corporation when a corporation opens an account with a bank today?
The beneficial owner is going to be the ultimate beneficial owner of the corporation. So the person, let's say it's an LLC, it'll be the person that has the highest percentage of shares in a corporation. So, as you know, Jonathan, in some jurisdictions, even here in the United States, there are jurisdictions that allow LLCs to have anonymous owners. And that can be a problem because when a company is being used as a shell, whether it's, let's say it's here in New York City, it's a shell company that's purchasing real estate, you don't know who the ultimate beneficial owner is. That's something that was actually happening last year when there were sanctions that were being enforced against some of Putin's allies. There were real estate holdings here in Manhattan, including a condo about 10 blocks away from where I live, where there were unknown owners, but had, based on the Treasury's research, showed that there were ties to Russians, and those accounts were frozen. So,
Gotcha. Okay. So in the Corporate Transparency Act world, once that law is implemented at the end of this year, all those LLCs and corporations are going to be reporting a slightly different beneficial ownership set of data to FinCEN, right? We're going to be giving everyone who has greater than 25% or who has any form of substantial control, all those individuals will be identified with all of their personal identifiable information in the beneficial ownership report.
That's right. Again, up till now, some jurisdictions did allow that degree of anonymity, and the anonymity does have its purposes. Some people just don't like to have, as you know, some people, you can type in an LLC name and find out who the owner is. Some people just want to be left alone. They're not doing anything wrong. They're not doing anything criminal. Some people may be hiding from an abusive, former spouse. So there are positive applications to anonymity and LLCs, for example. And I'm just going to stick with this LLC theme. Mm-hmm. But because there is that potential to use anonymous LLCs, as conduits for money laundering, terrorist financing, evading sanctions. This new rule has been promulgated, and it's going to be very interesting to see how this creates new processes for banks to comply with when they're doing CDD.
Yeah. So help us understand it. So today, if my LLC comes to your bank, you're going to ask who has the largest percentage of ownership, and that's going to be a beneficial owner, and that person is going to give you identifying information and documents. Under the Corporate Transparency Act, that LLC is going to identify all the beneficial owners to FinCEN. Mm-hmm. That document is going to get filed with FinCEN. And as our readers know, there is a rulemaking underway right now called the Access Rule, where FinCEN is working out what the regulations will be, in which banks and law enforcement can get access to the data that gets filed with FinCEN. How do you see banks using that sort of access in the future when all this stuff gets implemented and they're collecting information through their own KYC procedure on the one hand, but then there's a deeper repository of the same information available through the FinCEN access?
I think that the banks will be eager to use that, but I think that the banks are going to have a couple of questions. I think the very first question that the banks are going to have is, how am I going to access this? What sort of cost is this going to have? What sort of efficiency drag is this going to have on my operations? Compliance and other what we call middle office functions in a bank are cost centers. Banks are always looking for ways to optimize and make these operations more efficient, because every time a rule comes out, it's to have staff, it's to have technology. Pre-COVID and now even post-COVID, it's to have more real estate, more data centers. And so I think that the very first threshold question that the banks are going to ask is, I'm on board, what is this going to cost me? So again, I do think that in my experience, banks are very eager to do the right thing, but they're also cognizant of the fact that this is not a money-making operation for them. This is going to take money out of their profit.
Sure. I suppose in an ideal world, if I was the president of the Wilson Bank,
sure,
I would dispense with the whole KYC stuff. I would tell the customer, go give me permission to look at your FinCEN file, and I'll just make a copy. And if you told the government it was true under penalty of having committed a felony, so this is probably pretty true information. Why don't I just piggyback on the FinCEN file?
I think in a perfect world that would be the appropriate thing to do. I am not optimistic that the federal government, even though they're the one who came up with that rule, is going to see it that way.
Well, sure.
I think that once you get into the alphabet soup of regulators of the FRB, which is the Federal Reserve Bank, the OCC, which is the Office of the Comptroller of the Currency, if you're regulated by a state agency, the FDIC, the Federal Deposit Insurance Corporation, they all have, in at least one instance, a slightly different wording of the same exact policy that they're trying to implement. And so with all that being said, I'm not optimistic that that would be sufficient from their purposes. Also, keep in mind that these rules are always meant to be very high level and provide a general roadmap for the bank. So a bank is going to have their own risk profile. They're going to have their own needs. They're going to have their own sort of customer profile. And so it's going to be up to them to fill the gaps. And they may say, hey, this new FinCEN rule works great if you're bank, if you're the Bailey Building and Loan in Bedford Falls, New York, and you know Ernie the cab driver and Bert the cop, and they're honest, upright people. This kind of broad FinCEN rule will be just fine. If you're working in Midtown Manhattan or downtown Atlanta or Century City in Los Angeles or wherever, you may not necessarily know your customers, or if you do know your customers, you may not know who their friends are. So the bank is still going to have to fill their own gaps.
Right. And so what FinCEN has done with the access rule is said, okay, if you're a bank, you can have access to our registry of beneficial owner information, but first you have to get the consent of the reporting company. Next, you're going to have an agreement with us in which you tell us that you have policies and procedures in place to keep all this stuff confidential. You're going to have to certify that those policies and procedures are in place, and we're going to be able to audit you on those policies and procedures. Now, presumably those policies and procedures are going to be in addition to whatever policies and procedures you as a bank already have in place under your FRB, OCC, FDIC regulatory scheme, whatever that might be.
Right.
Well, what are banks like yours, what steps are you taking to prepare for this additional overlapping regulatory regime that Corporate Transparency Act will impose on you?
Sure, you're speaking my language. So as a hypothetical, let's say that the Dixon Bank is anticipating the Corporate Transparency Act to be, in effect, and it's going to apply to our bank. And what we would do is we would be working backwards from the day that the rule becomes effective. And we would start creating policies and procedures. And it's not enough just to write policies and procedures. You have to go through rounds of feedback with your subject matter experts within the bank. You have to get it approved by the appropriate person. At that level, it could be the chief compliance officer or the general counsel. It might be a board level document that requires the board of directors and the chairman to approve. So you've got it written, you've gotten it approved. Now you have to get it out into the bank to the frontline employees, all the way up to, again, the chairman of the bank or the chairwoman, as the case may be. That is going to require training. That is going to require during COVID, we would do Zoom classes, we would do PowerPoint decks, we would send out emails with newsletters, teaching people how to, conduct the new operation. And it's also, as you say, going to be an auditable item. And going back to the policies and procedures have to be written just so. It's very difficult to write them because not only are you taking laws and regs, in this case, the access rule, but you also have to take it and you have to break it down so that someone who's a frontline employee who, may look at this policy once a year needs to be able to pick it up, understand it, and walk away, and then go forth and do likewise.
Yeah. It can't be the tax code.
Right. It can't be the tax code, and it can't even really be most banking regs. When it's audited, audit is going to be looking for those policies. They may interview frontline employees to say, hey, tell me what your normal day is like. They may be testing any computer programs or systems that are in place to make sure that they are compliant with this rule. So, back to my earlier point, the banks will be on board, optimistically because they want to help, cynically because they don't have a choice. But it is going to create a little bit of a timeline of, okay, we have this thing coming down the pipeline. We have to, prepare ourselves and get ready for it.
Sure.
But
what does that? Oh, I'm sorry.
Oh no, go ahead.
I was going to ask, what does that timeline look like? If new regulation is announced on,
Sure.
The first day of April 2023, how long would it take your average bank to write the policy, get the policy approved, develop training for the policy, roll out the training, have an implementation date? Is that a 3-month process, a 3-year process? How long does that take?
It all depends. I think that the impact of the rule will dictate how much lead time the bank will want and how much time they'll give themselves. Let's say, for example, that it's a minor tweak to the Bank Secrecy Act, the bank may do it within 6 weeks. If it's a new policy or new rule, for example, the Corporate Transparency Act, and there's a new rule attached to that act that the bank's never seen before, it's not similar to anything that they've done in the past, they will need more lead time. It could take them up to a year. It could take them 2 years. I do think, based on what we're talking about, based on the fact that banks have had CDD requirements for decades, this is going to be more like my first example where it's a modification of an existing process. Mm-hmm. I do think that the scale of the company will dictate how much time they're going to want. So, for example, a bank like JP Morgan, which is massive, has tens, if not hundreds of thousands of employees. is just going to need, frankly, more lead time to get into place. However, going back to my example of the Bailey building and loan, I think that George could get that lined up pretty quickly within a couple of months.
Mm-hmm, mm-hmm. Okay. And I'm curious, is it your sense that most banks are already working on a procedure to comply with the upcoming FinCEN access rule, or are they waiting to see how that rule finally turns out in front of FinCEN? Because, there's been a lot of criticism of the rule and we really don't know how it's going to turn out.
That's right. I think it's the latter. I think that banks by nature are conservative, and they do tend to take more of a wait and see approach to things. Mm-hmm. I think that the banks are going to wait for this to be finalized, and then from there they will make all the moves that they need to make. I think if the banks were to do it right now, they or their shareholders would see this as a potential sunk cost of, we dumped a ton of money into this process. The Treasury decided it wasn't necessary anymore, and now we have to pivot, and we've lost X number of dollars.
Gotcha. And as you know, under the proposed access rule, which is still the target of some criticism, one of the concepts is that banks that want to access the registry of information are going to have to enter into this agreement with FinCEN, in which they promise that they're going to have policies and procedures to maintain confidentiality, and then they're going to have to audit those policies and procedures, and that in essence, putting an additional level of compliance and audit on top of your already existing compliance and audit regimes. If, let's say today we promote Harry Dixon and you're now Secretary of the Treasury, as a matter of policy, is that a worthwhile additional regulatory step to impose on banks? Or would it be better to have FinCEN rely upon the regulatory procedures that already exist for banks, in which they are already obligated by law to maintain confidentiality of all their customer documents?
Truthfully, I would say the latter. And the main
remember, you're Secretary of the Treasury.
I'm the Secretary of the Treasury.
Yeah.
The reason being is that banks are already underneath and understandably so, banks are a critical part of our economy's infrastructure. We've seen recently how panicked people can get with the failure of Silicon Valley Bank or Signature Bank. Banks are already under a ton of regulatory scrutiny. And I think in terms of financial crimes regulation, the level of regulatory, I don't want to say burden, but obligation that banks are under, I think that what's already in place for data privacy, for CDD, for reporting requirements, what FinCEN is proposing is new. And I think that it is something that is helpful, but the extra ask of you need to have a separate policy and procedure for this that is going to be audited by your internal audit, or theoretically could be examined by the Federal Reserve Bank or the FDIC or OCC or whoever your main regulator is. I think that extra burden could probably be absorbed in pre-existing rules. So that is my approach. As Treasury Secretary, I would say, if you look hard enough, I have a feeling that this is already somewhere else in the regs, and I would tweak that reg instead of creating a new obligation.
Sure. I have a hunch that many bankers would agree with you. So, Harry, thank you so much for sharing your thoughts with us today about the access rule and how banks are going to be able to utilize the Corporate Transparency Act. Any closing thoughts?
Yes, I do have a couple of closing thoughts. I think that, first of all, that once this is all hammered out, that the banks are going to welcome the Corporate Transparency Act and the rules, including the one we've talked about today. I do think that right now banks have concerns about cost and efficiency and how this is actually going to play out in the day-to-day business as usual compliance world. I do think that, as we discussed, I think that the rule probably would be better suited to tweaking an existing rule for customer due diligence. But, again, I am overall optimistic that between FinCEN and the American Bankers Association and the group of senators who, by the way, were bipartisan from the Senate Finance Committee and wrote a letter about this expressing their concerns that this will all be hammered out. And once it goes into place, within 6 months to a year, we'll start seeing positive results.
Sure. Well, let's all keep our fingers crossed and hope that's the case. Harry, thank you so much for joining us. And thank you, listeners, for listening to another episode of the FinCEN Report podcast.
Thank you.